And welcome once again to Investor's Edge. I'm Gary Kaltbaum, your host. Hey, thanks for being with us today. Glad you're here, ladies and gentlemen. Happy that you are listening. It is 7/11/2025. It's Friday. The weekend is here. One of the rare weekends I am not traveling. I am sitting here in hot as heck Central Florida. I'll be back up in the Northeast on Thursday to see the dad. He's being taken care of by my good brother Steve, as well as we have 24-hour help, 12-hour shifts, two wonderful nurses that cost a hell of a lot of money, but it's worth every darn penny. Hope you're having a good day. Hope you have a good weekend. As always, serious talk on everything that affects you. The markets, the economy, your job, your industry, tariffs, debt, deficits. We do it with no ulterior motive, no agenda, no bias. The only agenda is you and I and our future as they continue to destroy the future. And if you do not get this radio show in your city, we'll post it at GaryK.com. We'll also post it on X. I'm not saying Twitter anymore. I'll just say X. And if you don't follow me on X, you should. And if you'd like to email me, you just got to be nice. Why? Because we're always going to be nice back, unless you like Hamas. So, the outcome today, first off, we had said to you yesterday that Bitcoin had broken out of range. It was up another, I'll give you the number here. IBIT, the ETF, was up 4.2% today. So you have a confirmed breakout. Of course, doesn't mean it has to work, but so far it has. I also want to mention silver broke out again today. Broke out first early June, went up for a few days, made a right turn for about 4 weeks. Broke out again today. You can go look at SLV and you can see that chart. I want to mention gold, back above the 50-day moving average. That's now in a 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 weeks of trading range. Remember, about 7-8 weeks ago, we said to you we thought it was about to go range bound. So those are just a few areas: gold, silver, Bitcoin. That's the story. Well, kind of, sort of today, because we had a little bit of an opposite today. Recently, we have been telling you how strong the advanced decline figures have been, the broad market, how strong it has been. Today, we got the opposite. I'll start by saying on the New York, 1,229 stocks were up, a whopping 2,894 were down. On the NASDAQ, even worse, 1,152 up. 31.95 down. Interesting enough, those bad advanced declines on the NASDAQ was only down 45. And that was because Google up 2.5, Nvidia was up 1, Amazon was up almost 3, and you know how much influence they have on them. The Dow was down 280 today, S&P down 20, transports down 107. In the Dow today, let's see what I can find that is of note. And then we're going to talk about the little cause and effect with the word maybe behind it. In the Dow today, Amgen down 5. Amgen's been, I guess, stuck in the mud. American Express pulled back 5 and change. It's been on the strong side with other financials. Salesforce.com down 6. Very weak software stock. Goldman pulled back 4, Home Depot 3, IBM almost 4, Visa down 8, Sherwin-Williams down 6. And by the way, anything's possible. You know that, right? But we deal with what we see in the patterns, looking at a photo album for familiar faces. You know what the worst looking charts are right now? MasterCard and Visa. Big top potential. We do note there's some things going on fundamentally outside of their control that may be doing the trick. Anyway, just letting you know. So weekday, we have yet to do our full scans, but the broad market pulled back a little bit today. Nothing, I would say, to get twisted over. The small caps were down. Normal little pullback so far. Same for the mid caps. Again, just a somewhat of a rough day, notwithstanding some of the mega cap beta was in shape. So let's add a few other things first. Yesterday we said to you we saw some software names really getting hit, maybe even topping out good. ServiceNow down another $30 today. HubSpot $30 today. MDB $7 today. CVLT down $5 today. MNDY $16 today. Duolingo $10 today. Workday $6 today. Checkpoint Software $6 today. Software's getting beaten up here. Microsoft is the grand poobah of software. That was still up again today. Just letting you know. Other areas to avoid, as we have told you. Insurance looks to be in a void. The managed care looks to be in a void, though United Health bounced today, but others got hit pretty hard. Other avoids, well, oils are better. Not bullish, but definitely better. And I believe a few days ago I said, I don't know if there are voids anymore. And after that, just a smattering. Which takes me to, Argentina, avoid. That's just an area I follow, and it was in a bull market. Now it's bearish. Not that you care. Which takes me to definitions. It takes me to cause and effect. You see, last night, futures were flat. And then the president announced a 35% tariff on Canada. And immediately futures dropped, cause and effect. So let's put the pieces of the puzzle together, and then I'm going to some definitions. In just the past few days, 50% on Brazil. Not because of trade, but because the president is mad at the Brazilian government for being mean at their ex-president. My opinion, sheer insanity to have major tariffs on a country because how they treat an ex-president. We'll get to the fine print in a minute. Now Canada 35%, where the president is saying there's a fentanyl issue. Even though the fentanyl numbers have, I'm just reading this, have dropped markedly in the recent past. He went on to tariff Bangladesh, Kazakhstan. They don't, not to put these areas down, but they really don't matter that much. Japan is on there also. But we are being told they're looking at exemptions, so a lot of this may not be meaningful. The president has been made fun of with this TACO acronym about he keeps threatening tariffs and then gets rid of them and then does the exemptions. We're not going to make fun of him, but we are going to take him on because a couple of other things happened today and actually yesterday that I think is of note. I'd like to give you the rest of the story on tariffs that all of a sudden so many conservative free market people love so much. Today it was announced that for the month of June we had a surplus because of how much they collected in tariffs. This is true. There was a surplus, and you know how much we hate deficits. So there was a surplus. There's only one problem. We'll explain in a minute. This is the one and only Investor's Edge. Hey, welcome once again to Investor's Edge. It's being talked about, hey, we had a surplus because we got all these tariffs in. Terrific. I'm not going to argue that. They got a surplus because they taxed American companies who in turn, some of them charged higher prices to the consumer. It was a tax hike of whatever the number was that made it a surplus. Well, Gary, here's a great question for you. Well, if they do that every month, that $200 billion a month deficit, which is what we have now, we're going to have a deficit of 2-point-something trillion this year. Well, if they bring in that $200 billion in tariffs every month, then we're going to have no deficit this year. Interesting. Well, that's correct. There's only one problem. That would mean we ended up with a 2-point-something trillion tax hike. A gargantuan tax hike in 1 year. Worse than Kamala Harris's proposals. Which has me posing the question, what is that going to mean? You're taking $2 trillion out of the economy and into the government coffers. It's just a tax hike. And of course, potentially, a hike on the consumer. Well, I think there's a damn good chance there's your economic growth. So if they continue along these lines, I'm rooting for them. If we can get just 2% GDP in the next year while bringing in $200 billion of new taxes, which go directly to the Treasury, just so you know. When Walmart buys a crapload of stuff from Brazil or China or Canada and pays these tariffs, it goes directly to the Treasury. Thus, as I just stated to you, we have a surplus for the month of June. I would be thrilled to report to you in a year. We have 2% GDP, and we kept balanced budgets because of it, and the new tariffs/taxes. I'm rooting for them. I'm worried, but I'm rooting for them. I do not want you to forget that tariffs are just a tax. That's all it is. Now, what are the potential negatives? Well, if it gets to be too much, what's to say that these companies stop buying these things? If they're paying too much and they're losing money, why even do that business? There's all kinds of ways of looking at this, but when all is said and done, the only thing I will care about is outcome, and I am rooting for them. I completely disagree with this. I am rooting for them, and I will be glad to applaud them if it works. But those that are saying, oh, look, we brought in $200 billion. No, you taxed us $200 billion. The market, cause and effect, at least for today, doesn't have to get worse. But at least for today, there was a cause and effect on the announcement of Canada. And what you can do is go look, what are our imports from Brazil and Canada? And you will see, because as of now, we are being told 50% from Brazil, 35% from Canada. That means anything that comes in here, boom, the importer, us, not them, will pay 50% higher. If they're paying $10 for something, they now pay $15, and that extra $5 goes into the treasury. I think there will be repercussions. I believe in Economics 101. So that's a little bit of a cause and effect on what's going on, what's next. We'll keep reporting to you. Let me repeat, we are rooting for the success of what they're trying to do. We really are, because we are big time. We are big time deficit hawks. And if this works, cool. For the month of June, cool. Is the economy heading south in a big way? I ain't seeing it. So, for the month of June, cool. And that's your story of cause and effect on tariffs. So rough day today. I won't go any further than that. There are areas to avoid. There are stocks to avoid. And I will tell you, my left screen of a lot of technology names that are not mega cap got smoked today. And as I said, in software, a lot of breaking down at this juncture here. That is definitely one area I'd be very careful about if your name is not Microsoft. Microsoft remains strong. And that's a little bit of the story today. Gold, silver, Bitcoin, and oil. And oil prices have been ticking up. It was up a couple of bucks today, oil. We don't want to see that happen. And I have to make note, 10-year yield, 4.423, up 0.77 today. That's not good news. We do not want oil prices going higher. We do not want the 10-year yield going higher. That would be big time negative. That's the cost of capital and the cost of energy. That is a 1-2 punch no economy will be happy with. Thinks that's what went on today a little bit with the market also. Up next, the president wants whoever's running the Fed to lower rates from 4.25 to 1. Repercussions. That's up next on Investor's Edge. And welcome once again to Investor's Edge. So, it seems like I have to continue to do some explaining because on certain things, the President of the United States does not have a clue on the meaning of certain things. As you know, he says tariffs are paid by other countries. Doesn't have a clue. Or he's lying. But the next part, he says he wants the Federal Reserve, our Federal Reserve, to take the Fed funds rate, down to 1%. Right now, their target for the Fed funds is 4.25 to 4.5. The 10-year yield is now up to 4.423. In case you don't know, the federal funds rates is just a target interest rate that the Fed puts at which banks borrow and lend to each other. That's what it is. That's what it is. It also tends to give off where money market rates should be around. These are short-term rates. We're doing a little bond market definition. In case you don't know, there are different years of bonds, 30, 20, 10, 5, and of course you can buy them at any time in between. And all a bond is, you are lending money to somebody who pays you a yield based on market conditions. If it's a corporation, a more risky corporation will have to pay you a higher yield to account for some of that risk. Companies like, let's say, a Home Depot will pay less because they are Home Depot. I'm giving you an example. What the Fed does has everything to do with the short term, does not have anything to do or very little to do with the long term. And what we always talk to you about is the 10-year yield. And why? Because your mortgages and so many of your loans are attached or near that number. Typically, mortgages will be 2.5 percentage points above the 10-year yield. In case you don't know, back in the late 70s, early 80s, we had a crazy bond market where yields were like 15, 16%. Not for long, they came down. That was because of massive inflation. When Jay Powell was printing money out of thin air, and you know I was blasting him for that, he took fake money and bought the hell out of that long bond market to press interest rates down. That's how you got your 3% mortgages. Horrible move on his part. Terrible move. Doofus. Here is the problem, and this is what the president has no clue about. What did we just go through? Inflation. Inflation reared its ugly head. How did that feel? Good for you? Why did we have inflation? Well, go look up a term for what causes inflation. Too much money chasing too few goods. Well, since Powell printed to $9 trillion, there's your inflation. Easy money over easy money creates inflation. If the 10-year yield, the free market, this is the free market of investors, traders, speculators, and a lot of smart money. If the free market is saying the 10-year yield has been going up and it's now 4.423, but the president wants Fed funds to be at 1, two things are going to happen. One, that 10-year yield is going to go higher while the Fed fund rates go lower. Why? Number two, because the stoking of inflation, and once that gets out of hand, it is tough to put that genie back in the bottle. What did I say to you during all of Powell's stupidity? He is not listening to the markets, and if he continues to not listen to the markets, there's going to be trouble. If President Trump took over the Fed and took Fed funds rates to 1%, I am letting you know there's every chance the 10-year yield will go to 6 and 7% because of that. And I can promise you, the 10-year yield is the filet mignon. The Fed funds rate is spam. The 10-year yield will define the economy. The Fed funds will not. And if the 10-year yield goes to 6, 7%, we go into contraction and all heck breaks loose in a very expensive stock market. That's all. And this president doesn't understand it. And this supposed genius of a Treasury Secretary either is BSing and can't, or just has to be quiet because of the president. It would be nuts to lower the Fed funds rates to 1% when the real yields, the free market, which obviously this president does not believe in, is screaming otherwise. And that's what I was saying about Powell for a long while. The market was screaming at him and wasn't listening, and I got news for you. The market's screaming at Trump now, and he's not listening. The good news is with President Trump, when he crashed the market because of tariffs, he did listen to the market and got rid of them. But now it's obvious he hasn't learned too much of a lesson because he's gone back to them. The good news is I'm not hearing any 145% tariffs like he had on China. And the good news is there's a lot of exemptions. So just letting you know, the President of the United States does not understand the repercussions of screwing with free markets. The Fed funds rate should be within a half point of where the 10-year yield is. It's at 4.423. Jay Powell's at 4.25-4.5. He can go to 4. 4.25, maybe even 3.75, 4. But that should be it. Stay in line with the market. Why? The market is so much smarter than all. So I'm keeping fingers crossed once he gets rid of Powell, he doesn't put in somebody that has his lips attached to his butt and does that. Because watch what happens. You'll get an initial burst in the market because of the easy money, and then plop. And do not forget, I nailed it all for you under Powell, under same circumstances of not listening to the market. I was the one before anybody telling you inflation was coming. It was a gimme. I was telling you he was going to have to play catch up. Then everybody else became a genius after the fact. Up next, this, that, and the other thing, or whatever else. This is the one only Investor's Edge. And before I get your emails, don't forget, we couldn't care less who's in the White House. We want good policy. That's all. Joe Biden got an F-. Besides being a corrupt piece of crap. Donald Trump, jury's still out. He's in his, 6th, 7th month. Gets an A+++ on the border. He gets an A++ on his verbiage on crime, on Jewish students, on those ass clowns running the colleges. A++s. But when not doing right, you hear from us. And he ain't doing right on the economy, kids. I'm rooting for them. Tariffs are not good. I hope I'm wrong. And I absolutely mean that. Small tariffs, you can get away with. You can't do 50% on Brazil. You can't do 35% on Canada. By the way, Canada's our number one trading partner, I believe. Pretty sure of that. So, let's see. Next week. Well, first off, let's repeat a few things. Bitcoin broke out. Let's see if it sticks, and it's a good-looking breakout. Silver broke out 3 weeks ago, did a further breakout. Gold is in 12 weeks of trading range, but after a rally, and it looks like a bullish trading range, gold miners are basically the same. They look better, and they pull back some. Overall, the broad market was down today, but looked pretty darn good, and maybe we'll pull back a little bit more, but overall looks pretty good, and sometimes you need to pull back. My issue with a lot of the broader market is I don't know if there's earnings power in some of these companies. When I look at, let me give you a little example here. How about Caterpillar? Caterpillar's had a strong move back to the old highs with 24% drop in earnings and a 10% drop in sales. Deere, near old highs, 22% drop in earnings, 16% drop in sales, and by the way, 4 quarters of big drops in earnings and sales. What does that mean? Well, if the earnings and sales don't improve, it's going to leave with very high valuations and stocks that hit a wall. And those are just two in what I call the economically sensitive areas of the market. And may I add also, if interest rates go higher, you know how we told you, oh, look at the home builders and those areas, much, much better. And they are much, much better. I can promise you if the 10-year yield heads towards 5%, I'm not so sure they're going to stay much, much better. So that'll be something to watch also. Do not forget also that valuations, and they just put, it's pretty easy to put a valuation on the S&P. You take the 500 stocks, you total up their earnings. Simple as that. Add them all up, and you give it a multiple. I saw somebody on TV yesterday saying 6,600 this year and 7,200 next year on $285 of earnings. Well, the 6,600, that would be a 24 times S&P on that number they actually gave, and the market throughout history is only 17. So that's what we would call expensive, and that's to be watched. And the Buffett indicator. They got this Buffett indicator that's record highs. Warren Buffett has this indicator that it goes above this certain number, and I believe it's doubled above that certain number. So we're watching valuations also, though, as you know, the one thing we will watch first, pretty simplistic, what are the stocks doing? But just letting you know, these are things we have in our file manager. And if anything changes, we'll let you know. And if we get great growth, that'll take down the valuations. Great growth. That'll take down the valuations. I do want to report to you Florida. Homes for sale in Florida and the biggest markets the inventory has risen to the highest in ages. Just letting you know. Tampa, St. Petersburg, active listing jumped 28% in June from last year. Looking at that. Orlando, Kissimmee, Sanford, 34% from last year. We're watching. Sarasota, Bradenton, 25%. And we're also seeing a lot of pendings go by the wayside, not getting sold. And we're also seeing listings just go bye-bye. People are putting up their homes. They're not selling for 9 months after lowering prices twice. They're just taking it off for sale. So it is definitively becoming more and more a buyer's market. At least in Florida. I know other areas also. The good news is I'm not seeing anything in the way of real dislocations yet. And let's hope that doesn't occur because people tie their wealth to their homes. And by the way, this is going on while people still have 3% mortgages and don't want to get rid of them to buy a house with 7%. And that's that. Okay. That all said, you have a great weekend. Drive carefully. When you get home, do like we do. Quite simple. Make sure you hug your family. Make sure you hug your children. They will feel better. You will feel better. I promise. Stay well, be well. Better days ahead because of us. Good night.